Welcome to our informational webinar. Good evening. We're calling tonight a casual fireside chat, and we're very pleased that you've chosen to spend time with us. My name is Grant, and I'm going to be your host this evening. This evening, we are very pleased to have three company speakers with us to our fireside chat. And throughout our time, please drop any questions you may have in the Q&A box. If by chance you're new to Zoom, should be at the bottom of your Zoom window. It says Q&A on it, and feel free to use that. On your view menu up at the top right of your screen, if you're on a PC, make sure you choose the speaker if you want to see just the speaker, or the gallery if you'd like to see all four screens. We may answer questions in the moment if the Q&A works right then, but I'll likely hold them for our Q&A at the end. And please understand we may not have time for all of them. We're going to try to leave about 15 minutes at the end. At GolfSuites, we're about diversity in investments. And as I said earlier this evening, one of our speakers is going to be Jerry Ellenberg. And Jerry, if you can turn your camera on, we would love to see your smiling face here this evening. All right, well, there you are.
Smiling
good to have you here. And by the way, Jerry, I prepared a slide just for you tonight because we're having a fireside chat. So I just wanted you to know that I wanted to keep it warm here because
well, there's people, Grant, there's people on this Zoom may want to throw me in that fire. I'm not sure.
We'll leave that. I just thought in Florida you might want to warm up. Well, yeah, folks, sure. Jerry has over 40 years in experience in real estate, finance, and development. And he was the founder and general partner of LCAP Manufactured Home Communities, acquired over 100 properties totaling more than 40,000 rental units across 26 states with more than $900 million in transaction value. His expertise includes accounting as a CPA and founder of a public accounting firm and specializing in finance and taxes. He has a vision to create an engaged collective of investors, bringing to light his unique combination of financial and operational expertise. Thank you for being here, Jerry. And let's bring Scott McCurry on. Scott, are you there? All right, there's Scott. Scott is an experienced COO with a proven track record of success in the entertainment industry, including his former work as the National Director of Operations for Top Golf. His core skills include budgeting, food and beverage, operations management, catering, profitability, and coaching. Scott is an operations professional with a restaurant, hotel, institutional management degree from Texas Tech University. And Ryan, if you can come on in, Ryan Koenig has more than 25 years of experience in real estate development, general contracting, and construction management in single-family, multifamily, and commercial real estate. He has completed transactions totaling approximately $600 million plus in value, and I'm sure growing every day. And Ryan is also president of ERC Communities, a sister company of ours that shares many of the same investors. And gentlemen, it's all yours, and I'm going to back out and put some slides up for you to play with.
I think you're a little down the path there. We're going to move back a bit. Keep going back. There you go. There we are.
Oh, you start there? Okay, gotcha.
Okay, well, welcome everybody. Thanks for joining us. I see we have a huge participant count here tonight. This could be our largest ever. This is designed to be kind of a casual discussion about everything that's going on, bit of an update. Many of these webinars are more of an investment pitch. Tonight, we're going to just talk about some of the things going on. So go ahead, Grant, take us to our first slide. Okay. I don't think Grant, I don't think that's the first one. Grant's
yeah, I'm here. I'm just going to the slides in order. I've got Ryan and Scott introductions, and then this is my first slide.
Okay, all right. Well, then fine. Let's go to Ryan first. I can give some edification. Pull up the Ryan slide, sure. Okay, stop there. There we are. You just heard a little bit about Ryan. To give a little, I've got to move through this stuff as efficiently as possible, but a little background is necessary for those of you who have been on webinars before, there's things you don't know about this company. Ryan Kenning and I are actually the two original founders of GolfSuites, going all the way back to 2016. Ryan and I were in the home building business from 2011 till 18 or 19. And we did a couple hundred homes of fix and flip and new construction, and woke up one day to see a Topgolf being built right next door to our office. So we were tempted, Ryan tempted me to go over there and see it. And we sat there within an hour and decided, hell, we can do this. This will be easy. So, we discovered just how easy it is. But Ryan's a consummate builder. He is the president, COO of our ERC Communities Manufactured Home Rental Community Company. And he was originally the chief development officer of GolfSuites. We brought in other members of management a few years ago. Those members just left, and Ryan came back in and took over this position again. So the company, for the first time really in its history, is better represented now in terms of purchasing of land, entitling the land, permitting the land, going through design, and all of that. And so you're just in very good hands. Ryan, why don't you chime in with a couple sound bites about yourself here?
If anybody really asks me what I do, I'm the construction guy. I can answer pretty much random anything from site development to what color tiles going in. Our biggest goal in this business is to value engineer our projects. And that's my background, is coming in from multifamily, from single family homes, from commercial development, and building a premier product for the best price. One that also isn't going to have deferred maintenance and really look good in the end. That's our goal, is we want a good product, something that's going to be a playable design. Working with Scott, we're coming up with some new concepts for the Auburn site, as we'll lead into here in a little bit. But my background is construction. That's what I do, real estate, and it's a little bit about me.
Okay, good. Well, it's Ryan's pretty understated, but he really when Scott elevated, we'll talk about Scott in a minute, but Scott Curry elevated to chief operating officer here a month or so ago, he and Ryan got acquainted very quick, and they just really work hand in glove. But Ryan's construction experience is vast. He has managed construction for such companies as CalPERS, the California Public Retirement System, Zarimba Construction, Wood Partners, Camden Partners, Turner Construction, all major names that we know of. So he's a great co-founder and great friend in this business. Scott McCurry joined us pretty much at the beginning. He was hired in by management teams that we had put together, what we called the Nashville team, and was the only member, is now, but what has always been the only member of the management team who really came from this discipline, came from the company that actually proved the concept, which is Topgolf. I'll let Scott elaborate on that, but Scott is a consummate operator and embraces both of the key functions of what the operation of this business is: strong food and beverage background, food and beverage entertainment, and then years and dozens of developed and opened and operating locations for Topgolf for the golf entertainment side. Our previous senior management team, quite frankly, was a bit lopsided towards food and beverage. Scott comes in this new role as the top executive and balances that out. Scott, give us a couple sound bites on yourself.
Yeah, sure. Thanks, Jerry. Food and beverage guy, definitely. I'm the guy that gets to create the fun for everybody, which that's what we're all about for our guests and growing this great brand of GolfSuites. As Jerry said, and everybody heard, I am graduated from Texas Tech with a restaurant degree. Loved it ever since. Actually been in it before that. Was with Macaroni Grill for over 18 years, growing that brand, and then jumped on to Topgolf for 6 years. I was the first director of operations of one of their large sites in Katy, Texas, and then grew that company through national director, reported to the CEO and all that fun stuff, and had just a great time growing it and understanding what it takes to run an entertainment venue and brand. And then I was with K1 Speed, which is a high-end go-kart out of California, brought food and beverage to them as well and some fun. They're being very successful right now. And then I got a call from a friend of mine, Tom LaPlante, who introduced me to Jerry and the team, and came on with those guys in September 2019. And we've been able to have 3 units and then moving on many more. So look forward to it. And yeah, I'm the food and beverage guy. I probably look like I am, kind of, though. So anyway,
He's the guy. I'm on group texts. This change in management that we made, which we'll talk about a little later, it has me now a little more involved. And I see the team leading that Scott does on about a 20-member text and monitoring sales every half hour to hour. It's really fun to watch. It's like a fourth quarter football game on the weekends to watch this stuff. But I'll tell you, for those of you who are shareholders, this company that no matter when you invested, whether it was just today or back in the spring of 2019, I will tell you, if these 2 guys at the helm, Ryan Koenig, Scott McCurry, your dollars are in extremely good hands. Extremely good hands. This management change that we just did, I've just put a memo out to some of my internal investors, some of the founding investors, and used the term, quote, the most seamless operation I've ever seen. It's just been so smooth. There's probably close to a 7-digit, high 6-digit, potentially $1 million annual savings and overhead that's not going to be replaced. So it's just a very, very wholesome, very organic change that we've made that we're very, very happy about. So, all right, that's it on Ryan and Scott. So what's our next slide? This is a site update. Let me just intervene for a minute here. As I understand, this is kind of a fireside chat. We did go through a serious management change, and it's going to manifest in tighter construction, quicker development, quicker growth, and really a tremendous emphasis on strong brand standards. We have to rebrand our 4 golf location in Lubbock. We've gone probably a little too long in rebranding that. We're doing extra work at the new Baton Rouge location. Ryan and Scott have gotten in on this, took over this Auburn University location, which just went into firm contract today. It's been in letter of intent format for a few months. It's now in firm contract. We're going to get ready to close the site, start building. But you are in the hands of extremely hands-on, very technical, very proficient people here. You're not in the hands of what we call delegating executives that rely on other people to get things done. This is a hands-on group, and I think it's going to very much stay that way. So Auburn is next. This site was actually discovered by one of our share sales executives and got handed to the prior management team, kind of lingered around for a while. When the management team was changed here back in early March, Ryan and Scott got all over this thing, met with the city where it's located and got new design stuff. I might rely on Ryan and Scott to give a soundbite or 2 on Auburn. This site is a go. It is going to be officially site number 4. We have other sites that we're looking at as well, but we're very, very enthusiastic about this site. Ryan, give a soundbite or 2 on Auburn if you can.
Sure.
Some of its key features.
It's a 40-bay facility, single story, 6,000 square feet. We are going in with the concept of small boutique, but yet large play. One of the things we're trying to keep our brand standard, and I don't know if Grant was shared that file. We had a little elevation we could probably post. I don't know if he's able to get that to be able to show what we're going for. A lot of our investors may have seen our Tulsa location, the 3-story look of it. We are implementing what I call forever stamp. And what that is we want to take this design and move forward with it. That brand build out is critical for us. We want people to pull up and to go, hey, that's a GolfSuites site. And that's what we're looking at doing. So this single floor concept, we'll still have TrackMan. We'll still have the covered bays. It will have our good food and beverage that Scott and his staff provide, and still have the look and the quality of a well done facility, not a range, as we'll call it. We are looking at being that we just signed, we should be through our PUD development in about 45 days. We've brought a architectural firm in that is moving forward with the engineering and architectural plans to have hopefully shovels in the ground and permit by September, early October. That is, if the stars align with the municipalities and getting everything moves through properly and we don't have any red line feedback. Based on our conversations with the municipalities, I think we should be possibly in the ground a little bit earlier, but I will be happy at October 1st start date.
That sounds good. Let me comment, folks. And again, I don't know the count of who's been on these before, but you have heard me talk about this geographic economic spread that we want to do with your investor capital. We have made a structural decision to do these facilities, but in approximately the $6 million range. We want to take your capital. We'd rather have 4 $6 million facilities than one $24 million facility. They're faster to build, they're faster to open, and we can get more locations out in places like Opa-locka, where Auburn University is, in places like Baton Rouge, and several of the cities we're looking at. America probably has 300 or 400 of these cities that can't really afford and can't support a big $25 million complex. So we're going to go in with these absolute full service, every quality that the brand has, but in a bit of a smaller size, and simply have more of them. And we think that I'm very much into spreading economic risk on behalf of investors, and it gets money spent faster, gets facilities open faster. So that's it on Auburn. Grant, what's the next slide? Madison, Mississippi. I don't know, again, who's been on webinars, but Madison, Mississippi is a bit of an interesting topic for us right now. We bought this site almost a year ago and ran into some issues with the city government relative to design concepts and requirements that they were making of us. The site officially right now sits for sale. And we should know in the next month or two whether there will be interested people to give us a nice profitable price. Ryan and Scott right now are in a very close, very acute examination as to whether we can make that site work. And I'm leaving it to them. They will come up with a decision on this. Either one of you chime in on this, your current opinion on Madison, because there's been a lot of investors from Jackson that we have that might be on this call. We have a lot of interest in this, but what either one of you take this up, your current prognosis on your current prediction on Madison.
Sure. So I'll do that. So Madison is it's a beautiful place. Demographics are wonderful for us in terms of the income and the amount of population and so forth. The opportunity that Jerry did mention is working with the city and seeing if we can do some adjustments on some of the stuff that they're asking to make sure that the bottom line is where we need it to be. But overall, Madison would be a nice place to have a unit. It would be supported in that area. But like I said, we have had some fun with the mayor and so forth, as Jerry said. But we will be making, between me and Ryan, looking at it some more, getting some answers back from the city. We'll be able to make some better adjustments and decision making. Let you guys know where we go from there. But it's definitely a location that we are very happy about. But unfortunately, some politics came into play. So there you go.
Okay, next slide, Grant. Other sites, other opportunities. Always have a ton of those going on. Ryan and Scott are looking at what could be a bit of a remote possibility of a site at University of Alabama. They're going to get more data on that. We're always looking at sites, and I reported to these internal shareholders this morning that in my opinion, with Auburn being site 4, irrespective of what happens with Madison, but Auburn being site 4, it would be good if I think we could have a site 5 and a site 6 into the hopper this year. Maybe the site 5 and 6 wouldn't commence construction till next year, but we can get land owned and get it, into the entitlement process. You probably see our growth curve incrementally increase as we go through time. And we wake up in a couple of 3 years and hopefully we're doing 7 or 8 of these at a time. We just, have to get there. But again, those of you who've heard me before, I am very tightly constrained with what I can say under the regulations of Regulation A+ relative to prediction and projection. We're very tied down. If things aren't firm, I can't really talk about them. So we're precluded by law from doing that. But we are actively looking at land, and we smell some real nice growth here. What's the next slide, Grant? Okay, financials. Yes, let me talk about that. I want to talk about how this webinar was promoted, because could be a little bit of confusion, and I don't know that we have a slide for this. But in the webinar announcement here, it said an end. I think it said something like an end to cash dividends. We are not ending cash dividends. Any shareholder that's in this company now receives dividends consistently every quarter and will continue to. I'm going to be very succinct with what I say because it's very important, and you have some dates you really have to pay attention to. The current Reg A offering, GolfSuites 1, is in its 3rd Reg A offering, which ends May 6th. When that offering ends, we will start preparing our new one. Our new offering that will come out, the 4th Reg A offering for GolfSuites 1, will no longer offer cash dividends. So what is ending now is the option to buy stock and receive cash dividends. But if you are a shareholder now, or you buy shares by midnight, May 6th, you will be a cash dividend recipient. What is going to happen is that the next offering is going to come out, and it is going to offer stock dividends. And it is also going to offer a very attractive exchange feature where if you are a current shareholder, say you have $10,000 worth of stock receiving an 8% dividend, if you want to switch to stock dividends in the new offering, you will be able to exchange $10,000 worth of shares for $12,500 worth of shares to earn at a stock dividend rate. So that will all be in the offering. The part that I want you all to understand now, and we're going to be communicating this to everybody, is that up until midnight of May 6th, buy all the shares you want, get all the cash dividends you want. The next offering coming out will no longer offer cash dividends. They will be stock dividends, which add to the growth. And we're doing this because a very large percentage of our shareholders actually don't want the cash dividends. They rather have them reinvested. So this is our answer to that. So I want to make that very clear. May 6th, deadline to purchase shares that pay cash dividends. Now, let's talk about financials. Because of share raise capital our equity, the equity in the balance sheet went from virtually zero up to near over $4 million this year. So we have a very stable balance sheet. The 2 operating full year operating sites, Tulsa and Lubbock, generated just short of $1.1 million in net operating cash flow for the year. Baton Rouge had a loss, which is attributable because it's brand new and we were expensing some of the things you always lose in the first few months. It is now profiting, but you see a very nice cash flow. You will get these financials here in the next few days. They're being submitted to the audit firm now and then to the SEC. You'll be able to see the financials online at Edgar, and we can circulate them. So you have a much stronger balance sheet. We're raising more capital now in this year than we have in previous time periods. And the gross revenues for the chain are up something like north of 30% in the first quarter versus the first quarter of last year. That includes Baton Rouge. The same site revenues, Tulsa Lubbock versus this 23 versus Tulsa Lubbock 2022, up over 20% in the first quarter. These are interesting percentages, particularly with the weather hazards that we had and with the fact that the first quarter, and Scott, you may elaborate on this. I'm pretty sure the first quarter is our weakest quarter, isn't it?
Yeah, Jerry, you're correct. Yep. It's usually November, and then it's January and February, and then go into half of March. Yep.
Yeah. Okay. So we're very pleased with the performance, and that's going to plot again, as I said earlier, against a much lower corporate overhead here. So you have a stronger. We have a $4 million plus equity. I think that our equity amount as we end this year will go to 8-digit. It should clearly go to 8 digits, and we're investing the money quite prudently in assets. We own Baton Rouge free and clear, subject to a very small lease. Our debt positions are very good in these sites. And so your balance sheet that you're going to get looks, looks very much nicer. What's our next slide? I think we'll go to Q&A now. Well, there it is. This is what I just talked about. There's your 2.4 million first quarter 23 versus a million, just under $1.8 million for 22, up 35%. So we're, I wish I could take some pride in this, but I can't. This is really Scott. Scott gets all the credit for this, but it's just it's a great trend that we're seeing here. Go ahead, Grant. Okay. Yeah, I can see that my speech is getting a little out of line with the slides here. I just went over this one last time. The current offering ends May 6th, and it will be the end of cash dividend offerings. One last time, you're not going to stop getting dividends. You're going to get the dividend. You're going to keep getting dividends. You just can't buy stock anymore that pays cash dividends. So they're going to be stock dividends from here out. For those of you who like cash dividends, you're going to want to get into this here in this last few weeks. What's our next slide? Okay, now going to you, Grant, going to Ryan, going to Scott. Would you chime in on anything? Ryan Ellenberg is with us as well tonight. He might chime in on this if he wants to. Of any topics we think I might be leaving out here. I've tried to kind of zip through this as fast as I could.
Thank you, Jerry. I'm going to start with some stuff that appeared in chat. Mark asked or said at one point he chatted with the team about Tallahassee, Florida as a new location. Do you have an update if Tallahassee is going to be on the list?
I can answer that. We've looked at a piece of property there. The problem being is the position of the property. We are firm believers we want to be hitting to the east, not the way the property is laid out with the drive, etc. Coming in off the main road, we would have to end up hitting to the northwest. So Scott doesn't know this, but I actually nixed that property this morning. Being up there this past weekend and looking at it, we are constantly looking while we're on properties. We're constantly looking at properties. We have 16 earmarked right now that we're looking at. From what I would say is Virginia, south to Miami, over to Abilene, right? That's kind of our heat map right now.
You do like Tallahassee though, right? You like that market?
Yeah, I'm Tallahassee guy, so
yeah, right.
Definitely something I want to see. If somebody asked me, and Jerry and I have discussed this, and Scott, a Division I school is one of the things that draws us, college-wise, but also municipalities that have good job growth has not really a good competitor. So we want to go into the open markets right now. That's what we're trending and looking for. But we're looking all over. We're not just earmarked into Alabama. We're not just looking in Texas. We are constantly looking at property. We looked at a property in Michigan, declined it. We looked at a property in Virginia Beach, declined it. So we're looking constantly to answer a lot of the questions I'm seeing on the side there.
Okay. The next one is from Linwood, and it kind of goes in with that. Are you considering locating something in the Huntsville, Alabama area? And any thoughts about a site in northern areas such as Virginia or Maryland? I didn't know Virginia was north, but we'll take that.
No, compared to where you are. Scott, you want to take that?
Yeah, so just like Ryan just said, we are looking everywhere. I don't know if he mentioned we actually looked in Rhode Island as well, Virginia Beach, Richmond, Virginia, Roanoke, Virginia. I mean, there's a lot of areas that we're looking into. So if you have anything to give us, let us know. But we are looking into the reason you hear more about the Southeast from Texas all the way over up is just because of the weather. You get up into the Virginias and stuff, it gets colder, the snow starts affecting your play, but there's things around that as well. But that's why you mostly hear about what Ryan just said and Jerry's talked about is the Southeast. and of course, Texas on. But we will look at everything we can. We're open to everything.
If you said Roanoke, I want you to know that I'm here on the ground if you need me to go around, run around, and look at anything for you. So it's a good area.
Okay.
They may ask you to do that.
All right, sweet. Eric wanted to know about any potential sites in the Northeast.
Ryan?
Yeah, well, as Scott just said, we looked at one in Rhode Island. That's about northeast. Is we go a little higher, but we're definitely, like I said, we're not isolated to just Florida and the South. We are looking in Northeast, North. We haven't plugged out West yet. We like to keep it in a good travel distance for us right now. As we grow, we'll go where we need to go.
Yeah.
I think one of your factors, Ryan, is construction labor. And if you're dealing with strong unions, and then of course your service workers unions and stuff, you have different labor rules, different labor rates that affect this. So I mean, theoretically, a more expensive site to build should generate a greater revenue level, but that's something we have to do on feasibility. And what one of our mainstays right now is to try to hold our development cost all in per site this right around $6 million. A 40 bay facility in urban areas of the Northeast, I think 6 million isn't very realistic. I would presume you guys
Not with the land values.
Yeah.
Yeah.
And operation expense as well.
Yep.
Adam had a really nice question, and these are all, everybody wants one of these in their backyard, I think.
That's a good sign, probably.
Right? Considering Madison, how does the decision for Topgolf to break down in Ridgeland play into this decision? Having lived in Clinton, west of Jackson, he doesn't see the market being saturated with two golf facilities north of Jackson. I think that's Madison, Mississippi, maybe.
Yeah. They did announce that shortly after we bought our land.
Yep.
Scott, I might ask you to chime in there. Go ahead.
Yeah. So, I don't know if you guys know, but Baton Rouge is literally less than 2 miles next to another Topgolf. We are not Topgolf, nor are we going to compete with them. I want to make sure everybody's clear on that. And our product that we have to offer with TrackMan and our food and beverage and our price point, and a couple other things that we do culturally, will be fine in Madison versus the one down the road of a Topgolf. What we're finding, just to let you guys know, is on an average Topgolf, and time has changed. Their revisits is a unique number. They get less than two visits a year per person, per guest, if you want to call it that way. We get 2 of those every month. So we're a totally different venue, totally different concept. We're based on the community. You heard that about Division 1. We want to make sure that anywhere from families to college students to just, an electrician wants to come out and play and be able to afford it and hang out and feel like what somebody just mentioned again, and being in your backyard. It's totally different than what Topgolf offers. So yeah, we're not scared of that. We don't compete with them, and nor would we. So we're good.
So we would do fine in Madison. It would appeal to a different crowd. I think, Scott, Ryan, I think we're pretty much betting on the fact that Madison probably isn't going to go. I mean, I think it's a kind of one shot at 5, but it is worth kind of a last stab, last look.
Yep.
Okay. Len asked if each location is a wholly owned subsidiary of a parent company.
Yes. Well, yes. Right now, the structure is this. GolfSuites 1 is the entity in which you own shares, publicly registered with the SEC. It in turn owns what we call operating LLCs. It is 100% owner of GolfSuites Tulsa. It's 100% owner of GolfSuites Lubbock. It is a 50% owner of GolfSuites Baton Rouge, and shares that with a joint venture investor. And that's what we call an equity leverage model, where we share capital 25% and 75%. The investor puts up 75%. We put up 25%. GolfSuites 1 puts up 25%, but we share the profits 50-50. So we get a double benefit for our equity investment. We promote these joint venture investments pretty heavily. Right now, in Auburn. It looks as though GolfSuites One will simply own that itself. But that's the work I do. I could be on a call tomorrow morning at 8 o'clock with an investor who wants to join us there. And for every time we get an investor to come in and join GolfSuites One, that leverages our equity greater into further sites. So, but even in shared ownership, we are the sole managing owner. We have no shared management, no shared decisions. The investor positions that come in are 100% passive with no authorities of any kind. That it has to be that way because we have to maintain brand standards and we have to operate the facilities. Well, and further to that, Grant, it's interesting because we have had some investors who want to come in with us and they don't like the fact that we want to retain management. We can't do business with them. You can probably see I'm fighting some sunlight here. I'm either dark or I'm in a bad way here. So
can you
at
take
least
a
people
moment
can
to
hear.
pull the
I think
blinds on
hearing
that
me might
side?
be better than looking at me anyway, but well, that's fine.
Can you take a moment to pull your blinds on that side, Jerry? Might help you.
And no, it's in front of me.
Okay. Michael asked about the Hawaiian Islands, specifically Oahu, has prime real estate for this. Are you even entertaining this as a possibility?
I would think not. I don't think we have to get into that too much. I am going to bring up a concept here. I probably have very much off the record of a product that we're considering that might work in Hawaii, but we have to be pretty practical about what we're doing here. We have an investor, this investor who's in with us on Baton Rouge. He's also in on Madison, wants us to go develop in India. Well, that's a great concept, but I think we're crawling before we walk and we walk before we run. But that does bring up a topic that we are contemplating. I cannot project that this is going to happen. This is very provisional, but over the last 3 years ago, we were seriously considering doing what we call indoor simulator lounges, kind of a nightclub restaurant approach where, you have like 6 bays with simulated golf with the TrackMan and you're looking down at a screen picture of St. Andrews or Pebble Beach or something. And then with food and beverage and dining, a far less expensive model for us in urban dining areas, something like that. We're examining that right now. We're considering it. We can't say we're going to do it, but we like the potential if it turns out to be feasible, because it probably comes home at about 10 cents on the dollar, the total cost of developing a full driving range. And so, and could have very high profitability. So, I don't know about Honolulu for that, maybe a few years down the road, but if we were ever to do something out of the area like that, it would probably be something like that. Topgolf, in fact, has a few indoor simulator lounges. I've been to a couple of them. They do fine with them. They're a little on the vanilla side to me. I think we could dress ours up a little bit, but we will report to you folks as time goes by if we go ahead with those considerations.
Mark
Go ahead,
asked the question auto invest, and that's all the information I've got.
Say what? He wants to how to
Auto
invest?
invest. I don't know if that's an ROI question or
He's probably talking about dividend reinvestment through stock instead of cash.
Oh, auto invest. You're talking about like doing it like monthly?
Mark, give us a little bit more on that one. We'll come back to it. He also asked what size of land you need. So us people can go be looking for you.
I'll chime in on that. The land size varies depending on what your storm and drainage is going to entail, your wetland mitigation. We vary anywhere from like a pad ready site at 10.8 acres, we can call it 11 round up, to you may have to go as big as 18 with your storm drainage and retention. So it's varying. Properties we always, like I said, want to be hitting to the east. Reason being, when we get into the closes at night, when the evening hours, you don't want to be hitting into, as Jerry's dealing with right now, the sun.
Yeah, right.
So,
I can't even see my golf clubs, let alone the ball.
So that's the big thing. So that's pretty much your ranges.
Okay. Michael's heard about rumors of a facility like this going to Fort Wayne, Indiana. Is it GolfSuites?
That's not us.
That was easy.
Okay.
How about Big Ten school locations? They
Oh,
all
yeah.
have snow,
Don't get Ryan and Scott
not?
started on that. Man. That's
Why
what they
not?
want to do.
Treasure Coast of Florida.
We have looked over there, yes. Cocoa Beach, New Smyrna. We are, like I said, constantly looking where we will, what I call the ward board. We'll add a site, we'll look at it, go back next day, it could be gone already. We'll do our due diligence on it, look at it, and constantly view, research. Is it going to make it through zoning? Is it, any chances? Is there an overlay district? Are we dealing with some of the same issues that we're dealing with in Madison? All items like that. So we're looking constantly. Like I said, if you pinpointed from Miami, South Beach, and go all the way, we're looking everywhere.
Good. Grant, back to that. When you said auto invest, AUTO, you mean like automatic invest?
And it was auto reinvest.
Auto reinvest. That probably means the dividends. Unless a person wants to just buy shares like every month or every quarter. I don't really know. Ryan Ellenberg knows that procedure better than I do. Right now, we cannot reinvest dividends. We cannot do that. We've really tried to do that. We can't get our broker dealer to get away from some extremely laborious administration that just makes it not worth anybody's while. It's just way too much work. So we can't reinvest dividends, but I do think there may be a possibility once we open the new offering to have some automatic, like if you wanted to do $1,000 each month or something like that, we'll certainly examine that. Right now, I don't think we can do anything like that, but it is a great idea, and we do get inquired about that, Grant. We do get inquiries about that. People who want to.
Sure. Okay. What does long-term success look like for the business? Achieving a certain number of operating sites and packaging them together for a new investor, or this is the most common question. It really is. It's the exit strategy. This is an exercise where P times G equals V. Profits times growth equals value. And profits, is a rather objective term. Growth is rather subject. And let me try to explain this. If we had 25 locations and we were developing nothing, we would have, kind of this value here, if you can see my hand. If we had 25 locations and we were developing 3, we'd have kind of this value. Now, if we had 25 locations and we were developing 8 or 9, we'd be up like this, because the public perception of value is a combination of current profit and projected profit. And if they look at a company and say, well, you're only going to add 3 locations, your profit's only going to grow X%. But if you're going to add 8, it's going to go triple X%. That's my world. And the real goal here is to step one, get ourselves to a good number of locations. I think that's 25, 30 locations where you can really say we're now a major force. At that time, ideally, we would be developing, opening, and particularly, Grant, with these smaller locations, which go faster for us, more of a stamp out, more of a wash, rinse, repeat. We could conceivably be developing 7 to 10. And that doesn't mean construction, 3 or 4 might be in construction and 3 or 4 might be in planning and development at different stages, but to have, say, 8 or 10 in development on top of 25 locations. And if we ran that for a couple of years, we'd find ourselves with 50 locations. Now, if we're going to do $3 million a year on average on a $6 million location, that would be a $150 million gross income. It could come home to a $30 million net cash flow. And after debt service and so forth, that drops to maybe, 15 or 20 million, and you multiply that out at a 20x, and you have yourself a $350 to $450 million company. I would, that's probably a number that would have us all looking. And I've told people that there's 3 things we could do. We could just sell it to somebody for cash and everybody pay their tax. We could take it public through an IPO, which is a bit laborious, big job, but the growth in that the investors on this call achieve is all tax deferred. They get new shares. They don't have to pay tax on them, liquid shares, or we would merge with a public company. That's my favorite.
is that a public company would merge us. And in that merger, one shareholder can just take cash for his shares. Another shareholder can take shares in the new company for his shares tax-free, and another guy can do half each. And so that is the best monetization that I can see. But I will tell you this, we can't be talking about our PhD degree when we're, sitting here getting through 6th grade. We're a young new company enjoying every minute of it. It's a great dynamic time for us, but we have to, we gotta get this thing grown to the point it needs to go. That's why I tell everybody, this isn't some high-tech crypto, triple your money in an hour and a half investment. That is not what we're doing. That's why I designed it as preferred stock, first money out. That's why I designed the dividend, so people can have current reward while we, build this. Speaking of that, your 2 cash flows from Tulsa and Lubbock more than cover all of last year's dividends that were paid to the shareholders. So our offering circular allows us to use capital for dividends, but the cash flows from those 2 locations alone supported far greater than our dividends of last year. That's a little off topic. That's we could have a webinar dedicated solely to monetization. What do you do if? I think it's a little premature to have that webinar. I think time should be spent talking about how we're building the company up.
We'll get to 7th grade first.
That's right.
There you go. This may be tough
grade
for you to
school's a
answer.
lot of fun. Grade school's a lot of fun. It's a lot of fun.
This may be tough for you to answer, but Jared wanted to know if the stock price will change for the new offer.
Yes.
There you go. Simple enough. Once in Lavita asked, once the number of facilities are developed, could you offset having locations in the north, Canada, or other locations in the north?
Oh, I think anything's possible down the road. Ryan and Scott will make those calls. They really do have complete authority there. Who knows? Toronto, Montreal, these are great towns. They're, I presume they're pretty expensive, but any of those things are possible.
Okay. There was a follow-up question on suggestions of revenue for GolfSuites, and that was also from Lavita. And if you hit us at investors@golfsuites.com, we'd love to chat with you. That we'll just take that one there. Daniel said, any place in Wisconsin. Would you like to answer all over for all states and localities?
Just make it easy. We're looking
everywhere.
Our active, what I call the active roster, it's pretty much everywhere, if it makes sense. So once it gets to the board, it goes to, plan site layout. Does it make sense? Can we hit to the east? Then we go to the next step. Does it make it through zoning? Could it make it through zoning? What's around the area? What's our demographic? What's our analytic? What's the job growth? What's the wage and everything that goes into our full pro forma that we try to build this out to, one, know that we're going to have proper revenue. That's critical. If I don't develop a project that Scott can, put out a 35% growth increase on it annually, hey, that's what we need to do. We need to be able to build this into a long-term company where we can grow steadily. As Jerry said, it's a continuous climb. We want to be efficient. We want to purchase property correctly. We want to make it through zoning. We want time whittled down when we build stuff. Then we also want management to succeed. Proper management in place, GMs in place, sales staff, etc. It starts really identifying the site. Scott and I'll talk about it. We may even bring Jerry in on a comment every once in a while, or we just stick to it and kind of go from there.
These 2 guys, so that you folks understand what goes on here, these 2 guys let me pretend I have some authority once in a while. It's very kind of them, actually. It's a bit patronizing, but it's very
kind. This is an interesting question from Lavita again. How much building materials are purchased locally and earth materials for foundation, etc.?
Well, that's loaded question. Depends on where we're at. You know, you're bringing in, if we're bringing in stuff overseas, if that's the question, you are bringing in stuff from overseas, steel, structure, you're building that here, concrete plants are here local. I'm a firm believer, coming from construction, that's my background. I want to support the local businesses that we're building. Going with a contractor that's based in Alabama or based in Mississippi or wherever we're building, but you also want to source local, as long as the price is right. That's the ultimate end game here. We are building on a budget.
Question on interest rates from Chris. They remain higher. If they remain at or higher rates than current, how does that impact the balance sheet and operations?
Rates are giving us fits right now. Increased interest rates skew the debt equity combination. Where interest rates were a year ago, we could have a 75% debt load on an asset. A $6 million build would qualify for $4.5 million of debt. Right now, it probably qualifies for $3.5 million of debt because the debt cost is has now surpassed our dividend rate. One of the issues we have is how much yield we need in an asset, and then I have to leverage that yield to a debt component as much as I can to covet or to kind of hoard shareholder capital, because it is the shareholder capital that buys us additional sites. So that's a constant balancing act. I think that the economy, again, we talk about financial features, and then now we're moving over to economic features. Economics is a whole different topic.
Yeah.
And interest rates are a function of the economy, and you get obtuse government spending the way we're seeing it now. The COVID relief, the Infrastructure Act, all this stuff, all of this printing of money, of course, drives up the prices of stuff. And when that happens, all of the central banks of the world want to curtail growth by raising interest rates. Of course, when they do that, the banks have to charge more. Home mortgage rates today are double what they were a year ago, or in some cases more than double. And so interest rates are giving us fits. Now, I'm the oldest guy on the call, and I will tell you that I remember double-digit interest rates. I bought a house in 1984 and threw a celebration because I put 1/3 down on the house to get a 14% mortgage, and I was celebrating that rate. So I have a long-term history of interest rates and have a kind of a mild response to this. But granted, no uncertain terms, what this is causing is it is causing a higher equity contribution to the asset, which I really hate. I hate doing that. I got a $6 million asset. I want to go at that asset with $1.5 million, 25%. I hate having to think of going at it 2.5 to 3 million, because that obviously curtails our growth. So in plain English, interest rates, if they stay high or go higher, will clearly harass growth. It doesn't matter how much money we raise. Say, well, Jerry, just raise a lot of capital. It doesn't matter if we raise a lot of capital, because we could still buy more assets with that capital. So there's no way that high interest rates help. Now, flip that coin back to finance and say, well, high interest, what does that do to sale of land? What does that do to the demand for land? That might, push the demand for land down and make it easier to buy. Ryan and Scott have to answer that, because I'm not in that exercise. I don't really know. That plays against the demand areas we want to be in. Most of the stuff we want to buy is under demand, and so we have to compete heavily for it. But interest rates are not. No one's celebrating interest rates these days. That's for sure.
Very good. I got Ryan typing an answer to this one, but I'm going to go ahead and ask it since it's live. Why do we continue to hear that one offer is the last and then receive another offer for the same share price?
One offer is the last. I don't know.
I'll take that one. Depending on what emails you're getting or the order in which you're reading them, you might want to reach out to investors@golfsuites.com, because we have a pretty automated system for when the share price changes. The only exception would be for changing that is if you have a signed purchase agreement, which lets you hang on to the price for about another 2 weeks. But if you're having any technical difficulties or anything like that, most of everybody on here has my cell phone number. You can call or text me anytime. Otherwise, if you email investors@golfsuites.com, Kristen or I will be able to help you within an hour or two.
Thanks, Ryan. James wanted to know if you could explain one more time how the stock structure is changing.
I mean, in the new offering.
I'm assuming.
Yeah. We're forming a new class of preferred stock that is going to pay a stock dividend instead of a cash dividend, so that each quarter, suppose you invest $5,000, and I haven't made the decision yet on what percentage I'm going to do. I'm either going to do 8 or 10%. If we stay with 8%, you annually at $5,000, you get $400 worth of stock added to your portfolio, which would be $100 each quarter. That's simply what that's going to be. So somebody has $5,000 worth of stock. They wake up at 8% per year. In 4 years, they have 32% more, which is, whatever 32% is on 5,000, probably, $1,600. And so, that's how that works. Right now, you receive those dividends in cash. Your stock portfolio does not grow. The cash is distributed to you. So anybody on this webinar, and we're gonna be very careful that this gets. We might do just a seminar just on this grant. We might literally do a dividend seminar, a webinar rather. That I think it's worth it, so that everybody gets. And we put some charts together, put some math together, easy to do. By and large, up until May 6th midnight, you buy stock, you get a cash dividend every quarter. It'll probably take a month to 6 weeks to get the new offering ready. Say we open up, let's say in the middle of July, that new offering will come out with a Class B preferred, which will be paying you a stock dividend. And it'll be very clearly described. And then it will also have this feature where you can swap stock if you want. We have a lot of investors who don't want their cash dividends. They just don't want them. They'd rather see it grow. And so they will have the option to trade those shares into the new preferred and get stock dividends instead of cash dividends. So we're trying to accommodate those investors as well. So, but again, let's put on record here that maybe we're just going to have a dividend webinar. It may be worthwhile to do that, so everybody really gets a good understanding of this.
Good stuff, Jerry. Good stuff. Bernard wanted to know about thoughts about building near like mid-Atlantic casinos.
All over.
We have our Tulsa locations right next to a casino.
Yeah, we're and a nice one at that. I mean,
we're buying one right now in Tulsa.
Yeah.
And as Ryan was saying, we are open to everything, guys.
And I think our time is about up. So I'm going to ask the last question here. Does GolfSuites have any risk exposure in the regional community bank issues that popped up?
No. We bank with Wells Fargo and Chase. Well, I guess we do bank with that little bank in Lubbock there, but they seem to be okay. First United Bank, but that's a bunch of oil drillers and cotton farmers, I think, and us. But nice. We're basically a Chase and Wells Fargo customer.
Well, thank you all for being here. There's our contact information, 888-530-9093. And of course, we've said it several times here, investors@golfsuites.com. And for those of you that wish to contact us, there it is. Gentlemen, thank you for this fascinating information for us smaller investors and the opportunity this program offers us all. Jerry, Ryan, Scott, thanks so much.
Thanks you, Grant. Thanks for producing.
Yeah, thanks for everything.